Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about TLT. That is an ETF that tracks the 20-year Treasury. Today, we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I am the Senior Options Analyst at Ally Invest. On Tuesday's Stock Play of the Day, we looked at a short call spread in TLT ahead of the Fed announcement. Now, today we'll discuss how things worked out with the trade overall. Now, on a short call spread, what you're doing is you're selling a call, trying to capture some time decay, and then you're buying another call as protection. So let's see what happened in TLT. So TLT right now is trading at 145.07. I have a 15-minute chart that I'm showing you here of TLT. Now on Tuesday, it was the 15th of June. It was noon Eastern time. We always tape the Stock Play of the Day live. All day on Tuesday, it traded fairly flat, up a little bit on Wednesday. Then we had the Fed announcement, and then we actually ran up quite a bit to the 145 level. Now, a short call spread is a bearish trade. So that means this trade went against us. Now, if we go into the strategy, we specifically went out further in time because we wanted to be able to adjust our trade just in case things went against us. We had a little bit lower implied volatility, so going out in time brought in a little bit bigger credit to our account. So let's look at the trade that we did on Tuesday. We went out to the July 30th expiration, which is 42 days away. We sold the July 30th 144 call, and we bought the 146 call. So at this point in time, the stock is actually going up against already through our short strike. When we put on the trade, the underlying or the actual credit spread was trading for 42 cents. Now we see it trading for 94 cents. So the fact that we went up further in time kind of gave us a little bit of protection. And now we have some options that we can do. So in this situation, either we want to close out the trade and just get out of it. We lost about half of the maximum that we could have made on the trade. So the maximum that we could have made on the trade was 42 cents. Now we're down 92 cents. So let's look at how we would just close out the trade and move on. So if we go to the right rail and I click trade, we'll see that it pops up buy to open, the July 30 calls, sell to open, the July 30 144 calls, 146 and 144. So this would be a sell to close on the 146. The sell to open would be a buy to close. We're going to do the exact opposite, and they're going to be closing transactions. And then right now we have it at a midpoint of 92. So we're going to put a limit debit of 92, and that's where we're hoping to get a fill. Never a guarantee that we would get that fill. And then we would just move on with our trade and we'd go into next week's trade overall. But the fact that we went out further in time means that even though this market has ran up and now it's trading fairly close to our long strike, the 146 strike call, that we actually didn't lose a ton because of the way that we set up the trade. Now, we were wrong on our forecast. We were kind of hoping for a neutral to bearish market, and we got TLT running up a fairly decent move. It's not a real volatile ETF overall. We highlighted last week that the implied volatility was only right around 12% implied. Right now, I see it's trading right pretty close on these option contracts around 13% implied volatility. Now, if you wanted to stay short the marketplace, you could roll this trade potentially. So how would we roll it? That's how we would close it. We'd be marking it buy to, or I'm sorry, we'd change the buy to a sell to close, and we change the sell to a buy to close. That would stay the same. But if you wanted to go out a little further in time, I'm going to bring up the August 20th 63-day out expiration contract. And what you would be doing then is moving up in strike and out in time. And now would be the time to do it. Now, this is only not meant to be a recommendation. I'm just trying to give you a couple of ideas here. Ideally, the market's gone against us. We only lost about the maximum we could make. I would probably just close out this trade and go on and look for another trade overall. But if in this instance, I'm going to add a few more strikes, and this trade would switch from a sell to a buy, and this would change from a buy to a sell. We would then go up in strike and out in time. So we're going out to the 63-day level. We're at 146. So let's look at the 147, 149. So we'd be looking to roll to the 147. That would become our sell, and buy the 149. Now we're doing this for a small debit to the account of 33 cents. So you're adding some risk to this trade. So your goal here then, if you rolled up and out in time, overall would be basically I want to take a little loss as opposed to a big loss overall. So if I rolled this out further in time and I had to pay that net debit for this account overall, see how we got this all set up. So that's a sell to close, buy to open, sell to close. And we'd be paying a net debit to that account. So that doesn't look as feasible. You'd have to go out even further in time or go a little bit tighter to the money. So in this instance, what I would really look to do is just close out the trade overall. Ideally, we went out far enough in time that we gave ourselves a little bit of a buffer. If the market had went down, we would have just stayed the course, let time decay work for us, and try to capture as much of that 42 cents that we brought in when we put on the initial trade. So very straightforward trade this week. That's the first one we've had in a little bit that has actually gone against us. But once again, when we're setting up our trades here on the stock play of the day, what we're looking at is how would I set this trade up for the current market conditions based off of the way the options are priced. And in this instance, because we had low volatility, we went out further in time, and that time protected us against a bigger loss if as opposed to if we did it on a shorter time frame, it would be hurting us a lot more overall. All right, that's it for this episode of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and you'll get all of the alerts for the Stock Play of the Day. And I want to let you know we have a special treat on June 23rd. We're going to be doing an all-day digital conference right here on the Ally YouTube channel. So please make sure you click subscribe, ring the bell, and you'll get all the notifications for that event also. Thanks for coming, everyone, and we'll see you this Tuesday on the Stock Play of the Day.